Welcome to today's live. This is a late one, but I wanted to go ahead and do this live before I finish my day today because of some of the questions that I've received about this commercial real estate topic that I've been talking about since last week. So I made two posts last week about is it okay? It's live. Sorry. Okay, awesome. I see that it's going. So I made two posts last week about owning commercial real estate and what are the great tax incentives you get when you own commercial real estate. But specifically, I want to also make this again clear that I'm talking about people who already have a primary business. So you are running a profitable primary business. So regardless of what your professional is, I shared last time that a lot of attorneys do this, a lot of medical professionals do this, a lot of CPA offices do this, that you're running a profitable business, and other business owners do this, but those are the top three that comes to the top of my mind, or the top three that I want to talk about today. But anyways, so what normally happens is you're running a profitable business and you have some cash flow, and this is a time when you're gonna like, man, I probably can, buy a property where I can, instead of renting an office space, or if you want to move your office outside of your home or still have an extra office space, I can purchase this piece of property and use it as my office. So this is who this specifically relates to. So you want to do that because you want to be able to, not pay rent and have a second location for your business, or you want to think about it as a more long-term generational wealth or wealth building strategy. So both of those together are great ways of thinking about the commercial property. The model that people normally use, hey Chloe, long time, how are you? Hi Whitney, thanks for joining. The model that people normally use is they'll go ahead and get finance, they'll set up an LLC, and for legal protection, you can ask your attorney. I'm not going to say anything else about that because I'm not an attorney. They set up an LLC for legal protection and they purchase the property under this LLC. And what happens now, then they'll rent the building to their operating business, their primary business, and the primary business pays the LLC's rent for this property. Sometimes if the property is big enough, you can rent it to other tenants, have other business owners, have a little crew of consultants, accountants, the general suspects, attorneys, rent a part of your office from you, and they pay your rent, and it all goes into your LLC that owns this property. So that's the model I'm talking about. So this is not for people who are, acquiring a lot of, commercial real estate and want to invest in. I'm specifically talking about professionals who already have a profitable business and they want to add some form of commercial real estate, because not only is it freaking awesome for tax purposes, it's also really great for investment. So I made two posts last week that I talked about how you can 3 times your tax deduction when you purchase the building. So you guys can go check that one out if you're interested. What I want to talk to you about today are the other things that you want to think about before you purchase, in order to make sure that this is the wealth building machine that you want it to be or you anticipated it to be. And the first thing that I have here is the potential location growth. And you may ask your realtor, but your realtor may not even know anything about this. So this is where you want to do some research as far as, how the market has increased in that area for the past 10 years and what's the projection for it to increase. What are the state government doing? Are they putting some kind of complex close by? What are some of the things that are going to be in that area? Because not everyone who buy commercial property makes money down the road, and it's just realistic that sometimes it just doesn't work out the way you intended, just because of you may be planning or you didn't realize what was going to happen. Because two things you want to think about. You think about the location in terms of not only where you want to go to work, but you also have to think more about it as a bigger investment than even purchasing your personal home, you know. So you have to think about, you know, the potential to even resell it, worst case scenario, to resell it and, you know, buy next property, resell it to upgrade. So resale is never a bad thing. Thanks for being on, Sal. So reselling is never a bad thing. Sometimes, you know, you want to get something bigger, prettier, and so forth, so you want to resell. So you want to make sure this is in a location where people want it as well, not only you. Location in terms of where your clients or your customers are going to show up. And this goes back into the resale value as well, that, you know, if some other business owners supposed to acquire this property, is going to be in a location where their clients are going to come. Because we all know that, you know, if you're old enough to remember back in 2008 with the real estate market crash, that does happen in the United States, that property lose value. So you want to make sure that you look at those numbers. Gentrification is going on all over Atlanta right now. So you want to make sure that, you know, the numbers are looking good for the next few years for the location that you're planning to buy. The other thing that will also guarantee you that you're in a growth market is also the cap rate. They call it the capitalization rate. So this is how much rent is this area charging. I know a lot of times when people are buying real estate to rent their business to, they normally don't think about their fair value of the rent rate, but this is extremely important because this will tell you if this property will cash flow, or if you're going to be able to have problem reselling it, or if you have made a bad investment, really. So what you look at is how much rent can you make from this property, regardless if you're going to pay rent or not. As I said, the model normally is your main business pays rent to this new property business. That's normally the model. If you're not using that model, it's completely fine, but you can check out what other businesses in that area are paying for rent, and then you divide that by the total value of the property. Every is it jurisdiction, every area, every county or whatever has a different cap rate. So you look up, you know, which one is for your state and so forth, to make sure that you're fitting in those rates, because that's what other investors are going to look at when you're getting ready to buy your property. And that rate also tell you if you're making a good investment, because if people are not paying at least if you can't get the fair value rent in order to work with your cap rate, then that's gonna be a little dicey investments. There are other metrics that you can also use, but that is separate LLC or not. Yes, they normally do a separate LLC for legal protection for property when you normally own the property, and then you don't want to do a corporation or anything. You want to keep the property in an LLC. So that's normally the model. So the cap rate is what basically helps you decide, you know, the return on your investment and how much the property is going to cash flow. And you try to do this regardless if you're planning to rent your property or not. So that's what's important. And then, as always, see the growth pattern for the market. As I said, your realtor is not going to be able to tell you this. So this is something that you're going to have to do some research on, you know, probably call up your financial planner to give you some, I guess, some idea of where to start, or your accountant or something like that, some idea of where to start on that. Also, does the property need improvements? Are you going to do improvements to the property? So normally, your LLC that you purchased the building in can go ahead and do some general improvements to the property. And then, you know, you rent it to your main business, and your main business can do what's called other improvements, since your main business will potentially has the cash at that point, or if you're financing it, to make sure the right business I'm not going to say which business is the right business to do the improvements at this point, because this is something that you need to run the numbers on before you do the improvements, because there are massive tax deduction for these improvements if it's done in the right business. So you need to check which business that needs to do the leasehold improvements in order to get it 100% written off in the first year. So the other thing I'm going to say, make your life easy. So if you're renting this property to other tenants, so if you have your friends that, you're an attorney, you have your friends that are, CPAs, financial planners, and, medical, we know the regular crew, right? Or, your other friends that are attorney that does practice different area of the law, or your other medical friends. If you want to go ahead and rent it all to them, then make sure that you get a property manager to handle all the headache for you, because a lot of what people do is these people are your friends and so forth, so you just go ahead and draft up the lease and then you have to run into issues. Also, property can be sometimes an headache when things are not going correctly. So you want to keep your business profitable and you want to focus on your business so that you can generate more income to pay off this mortgage, right? So you want to go ahead and get a property manager to handle all of that headache for you. I have an awesome one in the Atlanta area. She helps with all my personal real estate stuff. I don't own commercial real estate, but if you want her for your commercial real estate, then she'll be great at doing that as well. But that's it for today. Before you go ahead and sign off, don't only think about this property, because I've seen this a lot in my business from other business owners. Don't think about it as something that's only for your business. You have to think 10 15 years down the road, because the worst thing you want to do is buy a property that's going to worth say for instance you pay $500 today and then it's still gonna worth the same amount, or even lose value a couple years down the road. And that does happen in some communities across the United States. I think other countries property value holds a bit more constant based on my research. But if you're living in any of the states that got hit by the financial market in 2018, then you want to also make sure that you're looking at those numbers. But that's it for today. Let me know if you guys have any other question. So I still stand to my point that you can 3 times your tax saving, because it's a reality. But you also have to make sure that you buy in the price point that will gives you the 3 times the savings. Sometimes you have to pay to play, right? The other thing is, some state government, based on what's going on in the area, they do have incentives for buying property in certain areas. So you can also check those out. Check out those incentives. Sorry. If you live in Atlanta, there's a lot of gentrification going on. So, I'm sure that a lot of those incentives are at work there. So I'll always make sure that you check for those additional state incentive. And that's it for today. I didn't introduce myself. So if you're seeing my video for the first time, I see a lot of new faces. Log on today. I am Ronica, and I help my clients to implement money saving strategy. I do tax planning, and this tax planning is specifically designed to help people reduce their taxes down. You're interested in learning more about getting the best deduction for your commercial real estate, then you can schedule a call with me in the link below, and we can continue this conversation. Have a good day.